Are dividend stocks a barrier to your future wealth? Are they costing you your future? Dividend stocks feel safe. It's cash on the account. It's real money that you can spend. And that's why it's so appealing to many people. But there's a cost associated with investing in dividend stocks. And the real question is, do they really build wealth for you in the best way possible? Or do they just make you feel comfortable while you're trying to build wealth? Let's dive in. Before we dive in, please remember, this is not financial advice. This is education and entertainment. Before you make any decision, be sure to do your research. What are dividend stocks really? Why are they so popular? In this video, I'm going to go through some of the most known examples of dividend kings, the most known dividend stocks or companies. And I'll tell you why they're not such a good investment. I'll also tell you when it actually does make sense to invest in companies that pay out dividends. Let's begin with the basics. What are dividend stocks and what are dividend kings? A dividend is when a company pays out part of the profit. When you invest in a company on the stock market, you become a shareholder. That means you become an owner. You own a piece of the company. Now, the company can decide when they make a profit to do several things. They can reinvest the profit in future products, in future markets, or they can accumulate the profit inside of the company, and then the shareholders' equity would grow. Or they can pay out the profit, part of it or all of it, to the stockholders, to the owners. When that happens, you will actually get cash on your account from the company when you own shares. And that is very appealing to many people because it's tangible. You can see it. It's right there. You can go buy a dress with it or whatever it is that makes you feel happy. I often see content creators rave about dividends. Some financial influencers have the goal of becoming financially free through the dividends, meaning that the dividends would pay their cost of living. Just this week I saw one content creator rave about the amount of dividends she got into her account as cash this year, and that it was enough to replace 1 month's salary. I followed this person for a while, and I remember following her even before my second son was born. He's now 9. So she's been doing this for at least a decade. And only being able to pay 1 month's salary with your investments when you've been investing for a decade, that's actually not very good. When you start investing, it might feel very abstract. You have some numbers on a screen. You know that theoretically you're becoming an owner or one of many owners in a company, but it's nice to see something tangible, cash on your account. And that's why it's so popular. It's popular because it validates that investment actually works. You get cash, you can buy a coffee, and there's an immediate payoff that reduces any doubt. It makes investing feel less like gambling and more like a real job. But the question is, are you approaching investing with the mindset of an employee? Are you addicted to getting that salary? Is that what you're looking for, really, to getting your salary replaced with dividends? Or are you being very smart about your investment strategy? There's a certain comfortable psychology about dividends, but comfortable and becoming rich in the best way possible are not the same thing. Now let's talk about some of the structural problems with dividend payments. Dividends are a sign of maturity, not of future growth. Companies that pay high dividends usually do so because they have nothing else to invest the money in. They have limited investment opportunities, and that's not a good thing. They are often mature, saturated companies that pay out cash and profits because they have nowhere else to place it. I guess that's fine if your goal is income. But let's face it, isn't your goal building wealth? It is not fine if your goal is compounding growth. A company that reinvests into future markets, future products, and acquisitions, they compound faster, if they do it well, of course. Dividends take away that fuel. When the company pays out dividend, that's money leaving the business, coming into your account, and in most cases, you have to pay tax on that money, and that cuts into compounding. If the company had reinvested in new opportunities, that money would compound better inside the company. Over time, those lost compounding opportunities will create a completely different outcome. It really does matter. Now, let's say that the company really has a hard time finding good opportunities for investing in new markets, new products, and so on. They have another way to distribute profit to the owners, and that's share buybacks. That is a much better solution than dividends. Just a second, let me explain what are share buybacks. Share buybacks are when the company buybacks their own shares. And when they do that, the company is divided into fewer slices. Let's compare it with a pizza. If you have a pizza that's divided into 20 slices, and you, instead of dividing it into 20, you divide it into 10, each slice will be bigger. Let's say theoretically you're going to sell these slices. Well, you could charge more for each slice. And theoretically, that's what's happening with each stock. Each stock would be worth more because it represents a larger slice of the company. Now let's talk about a corner of dividend stocks, the dividend kings. What are dividend kings? Dividend kings are companies that have paid out dividends for 50 years or more. They're paying out a very steady dividend. In most cases, they are raising the dividend a little bit every year. These companies are often very old elephants or even dinosaurs. Let me go through some of the most known dividend kings. Let's look at Colgate. So Colgate grew from 15.5 billion in revenue in 17 to 20 in 2024. I mean, I'm not impressed. It's okay, they are growing, but pre-tax income went from, basically it's been flat all these years. That's the short version. It did grew a lot last year, but it went from 3.5 billion to almost 4 billion. Let's take another one. Here you have Altria. Those are the ones behind Marlboro and other smoking products and vapor things and even cannabis products. Let's look at it. So basically, there's absolutely no growth in revenue. Not too surprising. There's no trend in cigarettes anymore. So they went from 25.5 billion in sales to 24. That's not beautiful. We don't like that. The pre-tax income did grow, however, from around 10 billion to rounding up to 14 billion. So some growth there. Let's look at the equity. Now, that's not pretty at all because equity, the money they are accumulating inside the company, has been declining from around 15 billion to minus 2 point something billion. That's not nice. I do not like to invest in companies where the equity is declining. Those are just a few examples. There are a lot of different companies. Some have more growth than others, but you really, really have to look into the numbers. Are they a shrinking business? Are they actually making money? And are they making more and more money? Companies that are shrinking are not great compounders. It doesn't matter if they pay out part of the profit. They are not great compounders. You have to stay away from them. Think of compounding like a snowball. A snowball rolling down a mountain. It will get bigger and bigger and bigger. When you invest, the money that already made money for you will make even more money. So this snowball will become so big. It grows exponentially, meaning in the beginning you can hardly see that it's growing, but towards the end it is such a steep curve. And that's the wonderful thing. So you really want to go with compounding. And the best way to create compounding wealth is to invest in companies that are compounding inside the company. That's why you want to look at the numbers. If the profit stays inside the company and they reinvest it in profitable business opportunity, you have a compounding machine. If they're not investing money in a profitable way, if they're paying out money, that money is not getting reinvested. And the other problem, like I said, is that you are actually being taxed on that money, depending a little bit on how you set up your investments. But in most cases, you will be taxed. And that means part of that money disappears. That's the opposite of compounding. Dividends are fuel taken out of that whole machine. It's like scraping off snow from the snowball rolling down the mountain. This is exactly why Warren Buffett's company, Berkshire Hathaway, doesn't pay out dividends. They buy back shares so that money can grow better in a compounding way. An important part about buying back shares is that it has to be done at the right stock price. Just like you want to invest when the price is right, the company should invest in itself when the price is right. Now, a bit of nuance. Dividends are not always bad. If the company is super profitable, if it's a real cash machine and it has nowhere to place all of that cash, even though it is reinvesting in the future, it does make sense sometimes to pay out dividends. One such case is Apple. Warren Buffett was actually pushing Apple to pay out either dividends or buyback shares. Cash flow was amazing and they were sitting on a mountain of cash. And that was not efficient either. It's really important that you get that kind of company at a good price. Don't just invest because it looks good, that the numbers are growing and they are paying out good dividends. You want to make sure that when you invest, the stock price is actually below the value of the company. The value in the company should be above the stock price. This is value versus price. Secondly, if you're in a situation where you need income, dividends might be an okay solution. If you have to live off your investments, if you need that income to pay your bills, dividends is a way that you can get that cash income without having to sell any stocks. But there are other ways to create a cash income from stocks. I'm really happy using options, but you have to be really careful with how you trade options. Don't do it on your own. Don't do this at home without some help. And in future videos, I'll explain a bit more about options. So stay tuned. If you want to learn more, remember to hit that bell button and subscribe. Make sure to be on my newsletter as well, so you won't miss any videos or blog posts. If you're really set on investing in dividends, make sure that the company is growing, that it's profitable, and make sure the stock price is below what the company is really worth. So instead of investing in dividend kings now, invest in compounders that will become future dividend kings when they mature. If you want to learn more about how to invest in wonderful companies, what a wonderful company is, what a company is really worth, be sure to download my free 7-step investing guide that will explain you all of those things. You can find the link in the description. In future videos, I'm going to go through some other popular investing strategies, like investing in gold. Is that a good idea? Or what about Bitcoin? So make sure that you are subscribing to my YouTube channel, to the podcast, and that you are on my newsletter. If you download the 7-step guide that you can find in the description below, you will receive my newsletter. That was it for today. See you in the next one.